Hey guys, what's up and welcome back to the Cryptoholic Bootcamp. There's a new column coming right away. Have you ever wondered why sometimes the price shoots up and goes straight down? There's a question about that. Everybody asks themselves that, and in this video I'm gonna try to explain why it's happened, how does it call, and how to understand it. Today we're gonna talk about one of the most important things in trading. Is it the forex trading or the future trading, or as we going with the crypto trading? The concept is called liquidity. Hey, I'm Kai. Who don't know me, I'm building this bootcamp for everybody to learn the trading, to learn especially the crypto trading, to make money from it. And we already passed the foundation and already passed the market structure. You can check the videos. They are all on the playlist. Every day there's a new video. I'm gonna try to explain the new concepts until we reach the level of confidence to trade together, to trade separately. I just want to teach you all I know about trading. I'm gonna provide you all the information which is necessary for the next few videos, in this column especially. I'm gonna try to explain for you what is the liquidity and how does the big institutions, hedge funds, banks and everything are using it to get into the market with a huge amount of money. So let's get into it. So first we have a question. What is the liquidity? In the simple terms, it's just to basically buy and sell at a certain positions, at a certain price. Liquidity, it's important for us to understand, but it's not that important if you want to trade, because we are small fishes. But liquidity is important for the big institutions. Smart money, as we call that, it's the big institutions, hedge funds, banks, liquidity providers who trades with millions and billions of dollars every day. They basically cannot buy or just sell with a huge amount of money. They have to bet against themselves. So they are going to both directions. Just in one direction there is much more money. So this is how the liquidity is created, and we're gonna talk about it. For you to get an understanding, liquidity is like fuel, for the cars. We all know the cars, yeah? We need a fuel if you want to drive somewhere. So it's the same in the market. It's the same in the market. The big institutions needs liquidity, needs to take out the future traders, get their money if they want to enter the huge positions. That's why they're betting against themselves, creating the liquidity, taking out the traders, and then entering with much more money into the market without spiking the price too much. The spikes, bam, and that's it. That's not good for the markets, that's not good for them. The same goes with the exiting large positions without spiking the price. And of course, to hunt retail traders like us, to take out our positions, take out our money, and leave us hanging with empty pockets. So that's why it's important to understand what is liquidity and how to use it to your advantage. So yeah, let's get into the charts, and now we have the Bitcoin chart with the 15-minute time frame. So one candle is formed in 15 minutes. Now I'm gonna show you about the liquidity. Of course, we can see some higher highs, higher lows. You can see some market structure movements. We know that because we talked about that, and I hope you learned about that. But I want to show you the example of liquidity grab, and how is it going there. Now, for example, right here we have a solid point. Yeah, we have a solid 15-minute time frame resistance zone. What the price does, it respects that, it goes down. Once again, another one, the wick, and down here, going down, and that one, it's going down. Yeah, we all see that the price is respecting our 15-minute time frame. What did the institutions did after that? The institutions drive the price above. Of course, there was the pressure from the bottom, but the main thing was this wick especially. Look, it is above the resistance zone. This is what liquidity grab looks like. Institutions created that, it went up, took out all the sellers, all the future sellers, all the retail traders from here with their stop losses. And now, when their car has enough fuel, they can push the price down. And look at that, there was a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 red candles. 10 red candles on the Bitcoin chart on 15-minute time frame. So basically, for the 2.5 hours, the Bitcoin just dumping. This is the fuels. And you can see examples like that with the support and resistance zones, with the supply and demand. We're gonna talk that in the future. The big players gets the fuel from the retails, from the small fishes like us, and after that they putting a lot of money. And we can see, I think, in the volume bar also. Look at this, especially this candle. There was a lot of volume. Also here, there was a lot of volume pushing the price above it to get into the trading. Yeah, you see the example. This is the simplest I can explain for you. Of course, there's gonna be a lot of explanations. You're gonna see a lot of it in my tradings, in my trade recaps, which I'm gonna start uploading after the bootcamp. But liquidity is one of the main things who drives the market. It drives it. It lets institutions get into the market with a huge amount of money. So you have to get the idea that that's important. We're gonna talk about it in the future lessons. I'm gonna show you more terminology. I'm gonna try to explain more topics about liquidity and everything. But for now, you got the idea. I explained for you everything, I think, for now. And thank you for watching. And I'm hoping to see you in the next video, because liquidity is fucking important.